Hello and welcome to Perfect Payments. As transaction banking evolves, how are banks dealing with IT complexity, centralization, and compliance? A Finextra webcast with Misys. And joining me today are Linda McLaughlin-Moore, who's head of cash management and liquidity EMEA at JP Morgan. Next to her is Ruth Wanderhofer, who's head of regulatory and market strategy at Citi Transaction Services. And joining us as well is Barry Kistlingbury, global solutions manager, payments and messaging at Misys. And we're looking at perfect payments, but also looking at, which I think is kind of almost the core banking business, never mind the transaction banking business. And a lot of banks are sort of looking to centralize their transaction banking business along sort of cash management and trade finance and of course payments. But banks, of course, both of your banks are global banks and global players, and that affects trade finance and the global supply chain. So, what role is globalization? I'll start with you, Linda, in streamlining payments and affecting banks' core business. How are banks responding to this?
Well, great question. Thanks very much. I think globalization within the supply chain function has existed for a very long time. I think some of the biggest differences today is that we're seeing a lot more progression and success in automation of that supply chain, and therefore making it easier and, quite frankly, cheaper to globalize some companies that would not be able to participate in a global supply chain. So when you look at globalization, specifically as it relates to linking customers with their customers and customers with their vendors, I think there's a couple of facets that we as a bank and our customers are looking for. And one is, how can we automate the chain of events faster and better, more efficiently? How can we minimize the settlement risks and the risks between the counterparties better, and hopefully more efficiently? And then thirdly, really looking at how can we help our customers interconnect better with us, as in direct connections between their accounting systems and our banking systems, but also how they can interconnect better with their supply chain overall, which certainly links to the technology underpinning it, which helps automation. But very often, automation doesn't always mean integration. It sometimes just means what it says, which is just automating a process that's there. And in integration, we really want to change that process to be more efficient. And quite honestly, it's the primary vehicle that's going to allow us to help our customers as they globalize and as they do more and more technology around the supply chain, actually get less risk. Because there will be higher risks involved when you add a lot of technology as well as a lot more complexity in the supply chain. Yeah.
I love all those words, automation and efficiency. They seem so simple, but when you take it in terms of, and IT complexity. Is this about expanding global reach, or is it more looking at partnerships?
Well, I think, obviously on the one hand, banks have expanded global reach, like our own bank and JP Morgan as well. But I guess for now, many banks are challenged with the expansion because we have all these global regulatory initiatives, Basel III, which are creating a lot of strain on banks. So I think the partnering angle is right now very much sought after. And as Linda mentioned, it's all about connecting the banks, getting a local partner on the ground, and making sure that the data can flow efficiently in a harmonized way. Because it's all about the data quality and the ability to analyze the data to optimize the risk management. And there we've obviously solutions on supplier finance, where you really effectively take the risk on the large buyer, which is a much lower risk weighting under Basel III than if you were taking the direct risk on the different suppliers. And that's a way to actually finance the supply chain very effectively. But it does help, obviously, having a global footprint in a local ground plus the network. And I think the alternative would be to have a partnering approach to create a similar impact, because you need the knowledge on the ground. Systems and processes are very different in the different countries. Also, back to the automation point, some countries are much less automated in every sense, and others are very sophisticated. But you also have local legal requirements, risks with trapped liquidity and other scenarios that you need to be aware of.
Yeah, you mentioned data. Dealing with data on a global scale is...
Absolutely. I think everything that's been said so far is accurate, but the the whole way of getting data across the entire bank is now the biggest issue, I think, because, as you said, we can automate processes, and that's, you know, something that we've been doing for a long time. But with today's requirements around Basel, it's not just what's going on in the wholesale bank, it's also what's going on in the retail bank, and therefore we need to have a good view of our cash flow and our liquidity across the entire bank. And actually being able to integrate all of that is the key issue. It's not just about automation, it's about getting that management view and knowing where your money is. But then that also adds on to what you can do to your customers. Then you can start offering your customers, if you know where shipments are and where payments are, so perhaps you can offer a service that allows you to release some of that risk earlier because you know that the goods have arrived in certain places and you can tie that into the supply chain. But to do all of that, you have to have that global view of what's going on across the bank, and that's really the biggest challenge, I think, that everybody faces. And the bigger the bank, the bigger the problem, I would say.
Or opportunity.
Or opportunity, yes, that's a good way of putting it.
You know, the two of you, what you just said really hones in on me, because really the opportunity that we're faced with now is all around. I say the word integration, but when you described it, it's really the real-time nature of the exchange that customers obviously always want, but we need to behave that way across our banks, and we need to help our customers behave that way across their companies. And then I think also the concept of globalization is really moving us towards not just the real-time nature of that, but also the expertise that's necessary. So, rightly so, we are looking to expand our footprint, but you can do that multiple different ways. You can do it through a physical brick and mortar, but the most important thing that we have to do along with our clients is to have that local expertise, regardless of whether I'm collaborating with a partner or I'm building my own brick and mortar. It's that local expertise tied to the real-time nature of that data exchange, which is the thing that I think all of us need to invest in.
Yeah, I think that real-time nature is absolutely key to making this work properly for our customers.
Sure.
And the idea of having local partners, I mean, I'm talking to a number of banks that we do, a lot of them have desires to have their own representation in lots and lots of countries, especially in Asia Pacific, being the region with all the growth coming. But it's just not possible, probably on a number of fronts. One, China, how can you get into China if you don't have people on the ground that know the local rules and how you get the job done?
And the local standards that are used.
And the local standards are, exactly.
That's right.
But then it's also time to market. It is actually just the technology piece of being able to connect up to their clearing systems and understanding how they work. And even though we're slowly moving to ISO 20022 for ACH type processes, and SWIFT tends to be the RTGS way going forward, there's still so many different little anomalies that go on in country that developing a solution for each country is very time consuming and very expensive. So it will depend on your strategy, and it will depend on what you want to do in each country, but I think you're going to have to do a bit of partnering, a bit of technology, but when you bring it back into the bank, then you need to have visibility across all of your systems.
I think it's also understanding exactly the client needs, because it seems that clients are really continuing to globalize seriously, whilst banks are almost put at a back foot because of all those local regulations that have come out after the financial crisis, which really look at protecting the local taxpayer and making sure everything is ring-fenced. And this is not in line with what the clients need at a global level. So it's that dialogue and that interaction between the client, the bank, and also the regulatory community to make sure that we can actually deliver to the clients what the clients need. Because no regulator, no government wants businesses to stop globalizing. They want businesses to grow because they prop up all the European and international economies. And I think that's where the requirements come from, that understanding the client and how the client evolves is dictating in the way in which we approach this, but also our arguments in front of the other communities.
But do you think that's a slightly different change for us? I mean, to really focus on what the client needs now?
Well, I mean,
it is the buzzword right now, that customer-centric.
I think I think that we've always focused. The banks have always focused on their customers, especially the ones that I think have grown their business in concert with their clients and are well known as our banks are for its exceptional customer service, right? So there has to be a focus on the customer in order to get to that standing.
Absolutely.
However, your point is well taken. We went into the for those of us that recall the 80s, we went from the 80s into the 90s where we really started to have a technical revolution as it relates to some of the big banks. And that revolution and that technology infusion really started to whet our appetite on how efficient we could actually get. The concept of, I think, the first true regional treasury in the European theater was actually in the very late 80s. And the first regional treasury center for any of our customers was actually in the almost near mid-90s. So, I think that we were growing, our customers were growing, we were starting to look at hubbing and shared resources and the like, and I think we got a little greedy with how much efficiency there was, which is the right thing to do for our shareholders, clearly, but at the same time, we became inwardly focused on how we could retool ourselves, right? And a big piece of the bank became inwardly focused. I think we still retained our client focus, but I think we're now looking to build technologies that are flexible for the customer rather than just efficient, right?
Yes.
So I think the definition of what we're looking for as an output has grown a level. It's matured into a higher level than just efficiency. Efficiency is just not enough anymore. We have to retool it.
Now I think technology is now there to allow you to do both things. Yeah. Before, when you did efficiency, you could do efficiency, but to then be able to perhaps be agile to your customers' needs,
that's right,
wasn't quite as easy as it potentially is today.
But I think today we're really looking at technologies that are open access for every client, so access can choose between banks. There's much more competition because banks are willing to open and use open technology architecture and modularity so that clients have the flexibility, because right now clients will need to have the choice for their own risk management to be able to switch between certain partners, and therefore we're driving a lot of the standardization when we look at the ISO XML globally with the CGI to actually make sure that corporates have that access flexibility between customer to bank, which is really very beneficial to them.
Crucial nowadays.
Talking a little bit about efficiency, are we seeing more demand for payment hubs or to ease this?
But depends on what you mean by a payment hub. I think
it's $1 million question.
Individually, we've been hubbing operations for a long time, as many of our customers have, right? Shared services, receivable centers, payable centers. But I think payment hubs, if you want to start changing that word to payment clubs, that's where I think the future is going to reside, in that how do we create opportunities where we can share amongst banks best capability, right? So if one bank wants to leverage the capabilities of another bank, that this is not just correspondent banking, because we want to do full integration, real-time exchange. It's a lot broader than that. And I think if that's how you define payment hubbing, then I think we're going to see an upsurge of that for a couple of reasons. To your point, where banks are inundated with regulatory opportunities, because I think and retooling some of our legacy processes in order to address those new regulations takes effort, and quite honestly, you need to really focus on what's important to your customers, right? And what's important to your customers is not always the inside of a bank. It's the services that touch the clients first, right?
Yeah. Reinventing the wheel makes no sense. And there are lots of systems and processes that are almost commodities within the bank. So if one bank has invested a lot in that system, then we're very happy to share that with other banks that have a very different client target market.
Absolutely.
So you just leverage really what has been already created.
And that's really where the competition is,
That's
right?
where the competition is.
The competition is not in the payment anymore. The competition is in all the information around the payment, how quickly we can help them reconcile their transactions. It's the stuff around it.
Straight through reconciliation as opposed to just processing.
Reducing settlement risk, hot topic now.
Absolutely.
And how do we help our clients reduce their settlement risk? Because ultimately the buck stops at the point of origination, right? So it is, right? It's interesting times we live in.
It's not the word, I know you said the word commodity, the evil word, but it's not. It's now value added, isn't it? It's not payment is a commodity. It's
the information
services.
is, the data is exactly the crucial point for risk management, for making sure that everything arrives on time. It's the data and the ability to analyze the data and employ it. Because many people have lots of data they collect, but they don't really do anything sensible with it.
Yes,
So I think that is the next
absolutely
step.
right.
That's absolutely crucial.
But I think that's part of, for me, the hubbing piece is once you've got the data centralized, then you can start being intelligent with it. And that allows you to drive better services to your customers, to other banks, you know, say, well, I'm good at this piece, you're good at that piece, how can we work together within a region or even globally? So it is about that data, and it is something I think that the whole industry has not been great at, because we have got it, it's all there, you've got enormous data centers with this data, but it's actually trying to make some sensible use out of it. One, to keep the regulator off your back, because it's there, you just need to be able to do it. And secondly, it's to then be able to, you know, make use of the cash flows, and you know where the money is, so your customers can actually do more business faster.
It's arguably the second technological revolution after the 80s. We need to kind of now employ what we already have in a more intelligent way. I think that's really what it is.
Well, and it's just that it's gaining speed, right? Technology advances are just so tremendous, and they're constantly moving forward that, you know, we have to keep up as much as we can. Yeah, it's interesting.
I want to talk more about technology, but in the beginning of this conversation, all three of you mentioned Basel III. And I don't think I've had a conversation in the past year that people don't mention Basel III. So, you know, I mean, what impact is, when you talk about local regulations, Basel III kind of is affecting everyone. What impact does that have on the whole supply chain trade finance?
Well, I mean, Basel III is obviously changing the way banks operate. It's there to make banks more safer, more resilient, and it is very much dependent on local regulators embedding those recommendations from 2010. So what we're seeing right now, we're getting updates from the Basel Committee. The latest one was in April, to actually identify which jurisdictions are starting to draft legislations to implement or have already agreed on legislations. And as usual, the European Union is the forerunner on everything. We've got the Credit Requirement Directive number 4, which is now in decision making, and we've managed to get a lot of best practice points in around trade finance, which was the most obvious point that the industry disputed for many, many months, where really with the International Chamber of Commerce, we gathered data to demonstrate trade finance has very low default rates, significantly over a long period of time. What Basel didn't really recognize is that there's a collateral, there's an actual transaction underlying. So it's not only about giving out a loan without any backup, it's actually the commercial activity that we're financing. And we've been able to bring in a lot of positive amendments into the European text, which we do hope is going to take sort of a best practice sign for other jurisdictions to copy. So it's all about the trade finance short-term nature. It's liquidating within up to 180, 190 days. So the risk isn't something that you need to calculate for a year or more. And also the risk quality is much lower risk than a mortgage loan, let's say. So that was the biggest point. There's, of course, lots of other implications. If you look at the G-SIFI charge, globally important banks have an up to 3% higher capital ratio on the Tier 1. The top one at the moment is 2.5, but there is obviously a deterrent of 3. So if you become even more large, you will have to put more capital to the side. And this will have a knock-on effect on trade finance, because it so happens that the global banks are also the key trade banks in the world. So of course there will be some knock-on impact on higher capital charges that will feed through the wholesale and retail trade finance system. And if you look at sort of long-term loans, they are clearly not favored under Basel III. So the liquidity regime, particularly the NSFR, will have impacts on things like export agency finance, which are guaranteed by sovereigns, and these guarantees have almost no relevance at all in the Basel framework. But we've seen in the Commission draft in Europe again that guarantees can be used. So I think we're starting to very slowly advance a better treatment for this area of products. I think things like cash management payments, there's no direct impact. The impact is really on the balance sheet across the bank of having more capital and having more liquidity and quality liquidity. We need lots of that. If we look at the OTC derivatives rules, everyone's wondering where do we find all that quality liquidity, because there are only so many German government bonds out in the world, right?
Well, a lot of the quality liquidity is actually sitting in the operating businesses, right? So I think that you're right. There's not a direct impact to the cash business, but in fact the cash business is going to be leveraged, instrumental in helping create more positive liquidity flows, right?
That's
so, which is terrific. Forcing the banks to yet again integrate, right? Integrate, drop their silos, and work across the firm to couple operating liquidity with
it comes back
longer-term financing.
To the data point, right?
It
You need that
does.
visibility across the firm.
That's exactly right. Yeah.
You know, you're one bank,
Fun
and there's
stuff.
no point. You know, we have technical silos, but we also have these silos of liquidity, and that's what they're trying to bring together, and that gives you that efficiency of global scale, and that's where you guys are hopefully going to be able to make the most of these opportunities.
We'll save the world.
We're certainly trying.
That was I think one of the least anxious description of talk about Basel III I've
That
heard.
was a great description,
I know.
actually.
I know
You're right. I mean,
Ruth didn't leave us much to say, really. Did she?
Trade
Covered it
finance.
all.
Well, it's a good point because trade is essentially a great example of actually how to protect,
Yes.
right? So
The unintended consequences were
yeah,
huge.
yeah,
It's
yeah.
not what they really want.
that's not what they really wanted. No,
exactly.
that's a good point.
That seems always
Very
with
well said.
regulations, unintended consequences.
Yeah, you know, you first write them and then, oops.
Yeah.
That's all right.
So I mean, when we're looking at sort of this bringing down the silos, you know, and not just what you mentioned, not just from a technical standpoint, but also from operational and liquidity standpoint. I mean, what have you seen any banks maybe really achieve this breaking down back office operations and creating greater efficiencies?
I think this has been a goal for over a decade, and I think it's a process that every bank goes through all the time. I can't speak specifically to how many banks have actually achieved that result, but I do know that most
But I
banks
agree.
that
I feel like
speak
I've been
to,
hearing it for about a decade.
But I think until technology ends, until the growth of technology or the next generation ends, it'll be a conquest or quest that's constantly being searched for, because we're always looking for more and more efficiency. And now when you layer a heavy piece of risk remediation requirements on top of that, it just creates a lot more opportunities to do more. I don't know if anybody will ever achieve the final result, is the point. I think it's going to be an ongoing process all the time. I do think several banks have made great strides.
Yeah. Well, there's always because the front office is always pushing at the new technologies to try and bring those in. So there's always issues of trying to control that. But I think there are some banks who have done a lot. Unfortunately, I think some of them are still potentially within silos within the bank. So perhaps within the wholesale bank, they have achieved what they were set out to do, to sort of automate and to look at all of their applications within the wholesale bank. But of course, that's only a part of the bigger picture.
Or as you mentioned, really the front office or the customer-facing side gets all the IT budget, while the back office.
Yeah, because that's seen as the piece that brings in the new business. And of course, with a lot of these regulations, it's not so much about the front office, it's about the back office and about how you control that liquidity level and be able to monitor all of that.
Yeah, but I think some of the larger, smarter banks see beyond that. I mean, I think there's been a lot of investment in the last, given the issues around the recession and how a number of banks have had to pull back. But if you take a look at the last 10 years, there's been a significant amount of investment, I think, in back offices.
Absolutely.
Yeah.
I mean, the whole joining of cash and trade years ago was something that was a first step to actually breaking the silos and getting this interaction at the client level, trade finance, cash management together. But I think now the next step, particularly in the transaction bank, is also to understand much better the other businesses and how all of those holistic rules like Basel III impact them. So what we do see is an effective silo breaking by actually analyzing and assessing the impacts on the systems, and that may lead to consolidations, centralization, and also employing new technologies to get better transparency.
But I mean, you mentioned centralizing cash and trade, but I mean, did a lot of banks just put them in the same building, or is this a real?
Yeah, I mean, well, I think the smarter banks took a look at where there was synergies, where there were opportunities. The benefits of a payment business is everything a bank does usually results in a payment, right? So you need to create the payments business within a firm, within a bank, almost as a utility in and of itself. And then the valuable pieces that you sell directly to your client, outside of just supporting the rest of the bank, have to kind of go on the outside of it, right? So depending on how you craft your technology. But, I just think the answer to your question is just not as obvious as as you might want to think there is, because as we continue to consolidate and move forward, there's new technologies, there are new needs from the customers, there's new markets. I mean, some of the emerging markets, quite frankly, have leapfrogged from a technology banking perspective, the Western markets. So, what has worked historically in the Euro market may in fact not work as well in an emerging Asian market, specifically as it relates to China, which is a distinct banking system in and of itself. But if you also capture the Middle East and Africa region and India regions, so
is that really one of the greatest barriers to this consolidation? You mentioned emerging markets leapfrogging. Well, would they be more greenfield sites while Europe has legacy infrastructure that it's difficult to change?
If you have, well, I'll let you answer that question. You're the tech expert, but I think don't keep in mind that the older legacy, as you put it, actually have also been building and creating and coming into the newer generations, because that's where the bulk of the volume is, right? So the customer, we need to get the best and the greatest in front of the customer, so we have to focus on that. However, do I think the emerging markets is a great greenfield? I would absolutely agree with that. Yes, I mean most of the most clever banks are doing a lot of their R&D and their new products in the emerging markets, because you get confronted immediately with high regulations, very different banking systems, all growing at varying paces, which allows you to really test out the new product or the new technology very quickly. But what would you think?
Well, I think they have an advantage from a pure technology aspect, because they don't have some of the legacy environments. I don't see that as the real showstopper, because I think you guys have got resources, you've got huge legacy is a terrible word, heritage. You've got lovely heritage systems that generate revenue, that have all that big data in them. I think the biggest issue really is just trying to squeeze the banks together and get over this silo mentality and say, right, we need to work together as one operation. That's how you're going to beat the emerging markets, not by throwing in perhaps another high technology silo.
I don't want to beat the emerging markets. I am the emerging market.
You want to get all the business out of the emerging markets. But that's what I mean.
When we look at the client again, I mean, the clients are ready for the latest technology. And if we work with the largest clients in the world, that's where we employ these things. And sometimes you can almost take away the aspect of local legacy formats and standards, because we then help them, for example, with XML, to have everything streamlined for them. So they send us all the data in one format around the world, and we have to deal with the fact that there are differences between countries, and that's why we're driving countries to actually adopt more harmonized standards, because the whole point is the world is integrating in itself, and therefore why shouldn't we have a European XML and an Asian XML that can talk to each other, so we have a global solution as opposed to everyone doing their own formats.
So I can't not talk about SEPA with you on the panel. You wrote the book on SEPA. But I mean, are we seeing a SEPA for the globe? Would that model be?
Well, that would be the idea. I mean, if you think about what happens on the client side, they already have a SEPA from the globe. With our largest customers, we have around 25% XML flows already globally, and what they do is they send us the XML file as they wish in a very large CGI defined template, and we make sure that it goes into the right formats for the different clearing systems. And the reality is that most clearing systems don't carry all the data. So for the benefit of the client who really needs data for the straight through reconciliation, we would like to see more systems to adopt that open large standard of XML ISO, which can be really defined as we see it in Europe over time, to embed much more data, payment on behalf of, lots of data on what is the nature of the payment, how fast should it be executed. There are lots of opportunities, but what we of course do see with the European market is it's a market of regional and local banks, and whilst they're being forced now with the SEPA regulation to adopt ISO XML, they are not necessarily in the same set of mind to adopt it in a large sort of template version, because they don't have clients that are keen to get the information. So there's a sort of dynamic between a local market that likes to still protect and maybe create some differences with additional optional services, their own sort of SEPA in Italy, SEPA in Finland, versus the approach with a global client that wants just one standard. But that is already a reality. So you could argue that SEPA regulation wasn't needed for global corporates. It was more needed for the European market to get to the same level. But how much competition you will get out of that is a question that remains unanswered right now, because most flows in the SME and consumer space are domestic. So I think that's not really going to give us the big kick. So it's a bit of a,
the kick that they originally thought.
Yeah.
I agree with you. I think standardization, if that's what you were referring to SEPA as, is exactly what the customers want, and in fact very difficult to deliver, right? Because each market is so distinctly different. And if you can get more out of your customers, the better. The key is to make sure that you get enough to make it seamless for the client to interact with you across all their markets. It's a tall order.
I mean, you've moved over in JP Morgan to Europe from the Asia markets. Were you watching what was going on with Europe, with the single Euro payments area?
SEPA was born when I was actually still in the U.S. Before I moved to Asia. I think we've looked in Southeast Asia. The ASEAN market has looked at what they could do to standardize and harmonize. We've seen a little of that, and even in the Middle East. In the MENA markets, to say, should we do, everyone starts out with, should we have a common currency, and then they quickly realize that's a real hard thing to do, because
probably hard to argue right now.
And 60% of the game really is the standardization, right? And no one wants to join, jurisdictions and commonwealths and so forth. So we really are sticking to the standardization. I think that's the best. So I do think we'll see natural pockets emerge, hopefully adopting what's already in the West. Not sure that's going to be as automatic. I think we've got a couple of large forces, China being one of, that are looking to adopt ISO, but they've only said that they're going to adopt ISO for the international market coming into China and out of China, right? So they still haven't given up their domestic foothold yet. And I'm not sure they feel that they have to. So I think it'll be interesting to see how this evolves. I do believe, though, the open structure of the ISO, absolutely, because it will be able to adapt, hopefully, to perhaps the 2 or 3 standard formats that will evolve across the world, right?
It's a question of time.
It's just a question of time.
I'd agree with that. I think the XML is the way forward. It's so much more of a rich message that you can, put that extra data in, and it can be tailored for the individual markets that you want it to be, without bilateral agreements that perhaps some of the legacy messaging standards we've used have had, which then means everyone has to have their own internal business rules to try and manage it, and that's the expensive part.
I mean, is it up for the banks to sort of help their clients with the XML portion of ISO 20022, or it's maybe some smaller corporates that might not be able to handle the conversion?
I think it's up to all of us to try and educate the banks, apologies, to educate the corporates. But I see more of that happening. You see a lot more banks and corporates talking about payment warehouses and what they're going to do in the next 5 to 10 years. Certainly in Europe around SEPA, there's a lot more large corporates that are saying, okay, it's going to happen now, so let's do something about it.
There is a question and a concern that many corporates have raised as to whether they need to adopt now XML for the SEPA market. We've been clarifying the discussion with the European Commission as to what really the rules are meant to be. So we're going to bring out some guidance at European industry level in a month's time. But really the idea is that, of course, we're supposed to help clients to get SEPA ready. Everyone wants to get them migrated. So if clients are not ready with XML themselves by 2014, of course the good thing you can do as a bank is to help them, or any third-party vendor can help the customer. It's all about getting them onto the SEPA slate, so to speak. If I talk about the large global corporates, they have of course embraced ISO themselves, and they're sending out all compatible. But we're talking in Europe, again, like with the banks, of a market of SMEs and smaller businesses that will have some more challenges. It's a one-off thing, but they may be able to leverage technology and conversion solutions that are done at market-wide level or done by specific providers, and that is an opportunity for them to go down the road.
But I do think that the banks are going to have to always have a strategy around helping customers switch.
Yeah, absolutely.
We've got a lot of the large corporates are purchasing other companies much more aggressively than they have in the past. Then they have to absorb them into the technology, which means you'll have a year or two cut over of that new company coming into the fold as the technology spine of the company. During that time, the treasurer is anxious to get them as part of the solution that they already have with their banks, and I think anything that we can do to actually help them migrate that old legacy technology from the prior company, perhaps even a very local company, right?
Yeah, exactly.
Can really be helpful. So again, that kind of that falls into the bucket of the payment is actually the thing that everybody does, right? It's how well you can encapsulate that payment with the data enrichment and the services that you can provide that are good, that's going to make a difference between the banking services.
And it's the choice of the client to either go with their own bank or go with another provider, but that choice has to be open, and it wasn't entirely clear from some statements in the past whether that choice is there, but that's something that we've been discussing with the regulators.
I mean, you all have talked a lot about the client, and which is, you know, understandable, but you've also mentioned a little bit about running payments as a utility almost, and sort of you mentioned that word commoditization. But I mean, are banks looking to replace that core payments revenue with something else, with something, you know, the services around it, like charging for intraday liquidity or anything like that?
From my view, I'd say banks would want to add to the services that they want to offer, and that's part of, if the technology can provide them with the ability to offer extra services, and all well and good. But I think with the times that we've been through in recent years, the actual payments business has kept a number of banks ticking over, and so I don't think anyone wants to change that as a revenue generating stream. They just want to use that to build other services.
That's take a look at what I see. The big banks care about, and we've all gotten better, not to speak for Citibank, but we've all gotten better at focusing on the important customers, right? Who's really important to us, which then leads you to the big question of, well, so what do I really want to be doing with those customers, and where do I want to invest? But the reality is the big banks are looking at growing with their customers, so you've got to have an investment strategy, and it's usually not cheap, right? Thanks to Misys and others, which everyone's got to get paid at the end of the day.
You got to pay for IT.
And then you've also got regulatory lift, you know, which the Western markets are getting a lot more regulatory mandates. We've got Basel coming out, that requires a lot of change. Again, investments, right? You've got the emerging markets who are spinning regulatory changes as they grow from a nascency to a more matured emerging market, and that then requires investment and change. And at the same time, we're trying to be efficient, right? So I think, you know, you need to create more and more value, especially when you're at the top end of your product life cycle, and that's where we're looking. We're looking around the payment to make it more efficient and make it less risky. I think all of the regulatory press, Basel, and several others have really highlighted the concern of what's the real risk that's involved in the payment cycle, and the real risk that's involved in the supply chain overall, even outside of the things that we sell. And I think the more educated the client is, the more they'll appreciate what it is that their providers are giving them, and the more they will then start concentrating and changing to meet the needs that are evolving.
Well, we're running out of time a little bit, but I wanted to ask all of you one last question, and this is kind of like my crystal ball question, which is, you know, we've looked at what transaction banks have been doing over the past few years, a lot of centralization. What should be the main strategic focus? I'll start in the middle, and then we'll go around. What should be the main strategic focus for transaction banks this year and the coming years forward?
Yeah, I think it's managing the dialogue and the strategy between the customer, the jurisdiction regulator, and the bank itself, by leveraging technology, but also by leveraging arguments. Because the whole point is, as I said earlier, the clients continue to globalize. We globalize with the client and make sure that the technologies that's evolving is applied in the most efficient way. But of course, it would not help if we have artificial roadblocks in the way that actually don't allow us to support the customer anymore. Because if we end up in an environment that is deglobalized from a banking perspective, but the client has to therefore rely on local requirements and local providers, things will get much more expensive and less efficient. So I think it's sort of that dynamic of regulation, technology evolution, and client needs that we need to manage best going forward.
Yeah, I'd agree with that, really. Your question earlier was also around, do you think we'd see some more hubs cropping up?
Yes.
And I think you will, but I think there's a number of banks that already do it to a degree, but I think there are a lot of technical architects now.
I had another bank say to me about a week ago, we mentioned definition, we define our payment hub according to Solent. They wrote a paper and they said that's what a payment hub is.
I think a hub is more than an engine. It's from the payment initiation, which is what you said earlier, all the way through to the clearing and settlements, and the money's in the right place at the right time. So, it's a wider view than perhaps we used to have a few years back. And I think that is starting to make sense for some of the architects in the banks that we talk to, and they're seeing that is going to have to change the way their internal systems work. So I think you will see more of this conversation. So we've been talking about hubs for the last 4 or 5 years. I think it's got to the point now where certainly I think the penny's dropped in a number of places.
So we've had the global argument and payment hubs. So where do you think the focus should be, strategic focus?
I think the transactional business is inclusive of liquidity management, the short-term liquidity, I think is moving into an era of risk management. I think we started this business actually in the late 70s and 80s as an outgrowth of how can we make our customers manage their payments and their risk, making payments quicker globally everywhere around them, the risks associated with that, the automation of trade, etc. And I think we're coming full circle, and the focus will be going forward that next generation of risk management and how the transaction businesses can play a role in that.
Excellent. That's great. Well, thank you very much, three of you, Linda, Ruth, Barry.
Thank
you very much.
Thank you.